So hello, welcome everyone. Today is a very interesting episode that we are doing with the Blockstream team. We are actually interestingly launching a new product on our platform, the Blockstream BASIC. It's an interesting product that invests into the Bitcoin ASICs industry. And that's the reason we have a very interesting guest with us, Dr. Adam back and James. Adam, if you want to give a quick introduction, I think definitely you don't require too much of introduction because you're one of the selected few who have been mentioned in the white paper and the Bitcoin white paper back in the days. But still, I think for the audience who is new to the industry and who doesn't know Bitcoin that well, maybe for them it will be an interesting introduction.
For myself, I have a connection to Bitcoin, which predates Bitcoin, which is I invented the Hashcash, which is the proof of work system that all the Bitcoin miners execute. And that was for a related domain, sort of anti-denial service and earlier eCash kind of R&D discussions. And so in the Bitcoin ecosystem, Blockstream is a vertically integrated Bitcoin company. So we do Bitcoin layer 2, sort of Lightning and Liquid, which is a layer 2 for actually securities and stablecoins and Bitcoin and so on. The basic note is actually issued on Liquid as well. So that's a kind of related technology. But Blockstream is also active in the hosting and mining space. So we provide effectively co-location to customers. So people who want to do mining buy the machines, they'll negotiate with us to do hosting. And James Macedonio, who's on the call, is our head of global mining sales. And so he's the person that the enterprise customers will talk to about negotiating, a multi-megawatt hosting contract for hundreds or thousands of miners, that kind of thing, right? And so we have quite a deep sort of set of experience and knowledge in the mining space. So as well as my historical connection to the actual algorithm at the core of the sort of specialized ASICs inside the mining machines, we have industry experience of the actual mining activity. So Blockstream has done mining in its own right for itself as a company. We sold the Blockstream Mining Note, which is another Luxembourg securitized vehicle, also managed by STOKR. And we provide hosting to other customers. And in 2021, we acquired Spondoolies, which is an ASIC manufacturing machine company. And so, they have actually industry contracts into, the foundries and the actual ASIC design and internals. So between that whole sort of sector of activities, we have kind of top to bottom knowledge between, hosting, power, the market for miners, and so have an interesting set of contacts and knowledge basically, and some years of experience operating in this space.
So maybe before we're heading over to James, Adam, when you explain a little bit like what are like ASICs miners, so for the audience who are not so familiar with this specific topics, what they are doing, what is their role, and you can highlight around that.
Yeah, so now people will probably have heard that Bitcoin involves proof of work, and that is a sort of a digital analog to gold mining, if you consider Bitcoin as a digital gold. And so actually what happens is you have computers which are calculating a mathematical function and trying to mine Bitcoin, so it's an intensive electrical use. So it's a bit like, high performance computing or cloud compute or AI compute. There are many servers in data centers, or actually people can mine at home as well, doing this function. And it turns out that if you want to do something with very high efficiency, you need to use a specialized optimized machine. So if you're familiar with your, a gaming computer, that you would buy, a specialized GPU, which is faster at doing graphics than a general CPU. And so it is with mining. They have specialized ASICs that can only do mining. So they aren't really very useful for anything but Bitcoin mining, but they're extremely efficient and fast at it. And so these days, the Bitcoin hash rate is all provided by these specialized ASICs. And of course, they undergo an upgrade cycle. Every 3 or 4 years, there'll be new, more efficient miners in market, and people will phase out the old ones and bring the new ones in. So you can think about it as a quite industrialized data center operation, at least for the bulk. Though individuals do some mining by themselves in a garage or in a small warehouse unit as well, or in the home. So it's a decentralized activity that's very global. And it's all in furtherance of this same operation, which is processing Bitcoin transactions, mining new Bitcoins, and there's an economic model there, which is as a miner, you try to keep your operating costs low, you're trying to have efficient miners and mine Bitcoins below the current market price and recoup your investment, recoup your capital investment into the miner.
I think perfectly, like you summarized, like what the ASIC industry is like. I think you explained a lot of things, and I think connecting to that point, I think James, your background is very interesting. So
hello everybody, how you doing? I'm James Macedonio, the Senior Vice President for Global Head of Mining for Blockstream. Blockstream and I came together about 2 years ago, which I think was a perfect fit because I come from over close to 30 years, if not more, in the infrastructure business, starting in the financial industry. I built out electronic trading platforms for some of the largest financial institutions, which we leveraged colo facilities. And I even worked at some of these colo facilities during some of the downtimes in the financial industry. So I thought it was a perfect fit for me to come over to work with Blockstream, because a lot of what we're doing on the mining side is hosting for others. We're providing colo services, and I'm bringing all my experience, my 30 years plus experience, to Blockstream. In addition to working in the financial industry, I spent many years at AWS, Amazon, selling their services. So the synergies between my finance background and my Amazon cloud background, that was a perfect fit to move into the Blockstream world.
Perfect. Thanks a lot. And for the audience, just to give a quick introduction about the host, it's me, Arnab. I'm the co-CEO of STOKR with Tobias, my co-founder. He's on the other side. And the role of STOKR is very interesting. We are an asset tokenization platform based in Luxembourg. And STOKR primarily supports Liquid network. It's a sidechain of Bitcoin on which you can issue regulated financial assets. And with Blockstream, we did a very interesting asset that is a Blockstream Mining Note in 2021 that actually also is part of one of the very interesting strategies that STOKR has taken over the years, is focusing on the different financial assets that can be created for the Bitcoin industry as a whole. First, we took a securitized kind of the hash rate, and the BMN was issued. Now this time it's kind of giving an investor an access to the ASICs market and providing an opportunistic kind of investment strategy for them. So going into that direction, I think that there are quite some questions. We will go into details. We'll try to understand the market, how this entire Bitcoin ASIC market works, because it's a very interesting industry. Over the last couple of months, I learned a lot personally, I think from James, from Adam, and the entire Blockstream team. And I think we'll share more insights on that. But also we'd like to discuss more about the basic instrument and how the instrument is structured, the functionalities, and all the details there. So without spending more time on the introduction phase, I think let's come to maybe the questions, and let's try to understand maybe the market. And this is very important, is where we are currently standing, because we are at the Bitcoin price around 30K. Definitely the miners market is interesting because we saw a lot of bigger, I would say, liquidations, bankruptcies in the last year. And that means the market is going through a very increasing volatility. On the other side, you have the macroeconomic environment, which is also, it's not a low interest market anymore. So I think the question is for both Adam and James is what is the current market scenario of the mining industry as a whole? So how do you see the market at this stage? If you can give some more light on that aspect.
Yeah, so I mean, people who are engaged in mining activity are basically buying ASICs or miners, finding somewhere to power them up, and trying to do so efficiently, with low operating costs, low electrical costs, low finance costs. And interestingly, the Bitcoin mining market is a market where definitionally somebody will be making a profit, because or the more efficient operators will be making a profit, because if they weren't, they would stop. the hash rate or the total number of people mining would fall, and that would increase the profitability of everybody else. So it's a very dynamical system which keeps in a profitability band for a range of miners. And so, and then let's summarize the Bitcoin market. So in 2021, we saw a high in the Bitcoin price a couple of times, like 65,000, and then another high, 69,000. And that was a kind of bull market. It was regaining a high that was a 20,000 high that was achieved in late 2017. And so Bitcoin price went past that. And so, that as the price is getting higher, mining profitability is increasing. So I would say in during 2021, there was a very big shortage of miners. So the manufacturers couldn't make them fast enough. Bitcoin profitability was going up and up because the price was going up. And to manufacture new miners, the manufacturing process takes about 6 months. And if there's really a shortage, you have to join a queue of people waiting for miners. And so, the time between paying for the miners and getting delivery might be 9 months, 12 months, or, you'll buy some miners and then they'll give you a schedule. In 9 months, we'll give you 1/12 of the order for the next 12 months. So even it could be the case that you would be looking at, 19 months between placing the order and receiving the last of your miners. And so that is why the market conditions in 2021 are still having a side effect in 2023, which is that in this period where there's a shortage of miners and it was very profitable to mine, people doing mining pre-ordered and paid for a lot of equipment. And as we know, the market fell after later in 2021, and sort of generally sideways during 2022 and starting to recover a bit this year, up to 30,000, so up 80% year to date. And so effectively what you have is oversupply of miners at this point. And so the people that bought the miners, they'll receive them, and if they don't have anywhere to power them up, they'll just store them new in the boxes. Or they're typically delivered on a shipping pallet, and so the industry term is like new on pallet. And so, there are many hundreds of millions of dollars of new on pallet miners in different industry players' warehouses, and even the manufacturers have some. And so, now people are adding miners to the market. The hash rate has gone up about, I think, 40% or so year to date. And so that is a sign of people taking their miners from storage, managing to buy, to either put power online or to negotiate a hosting contract, with James, for example, or other companies. And then they'll put those miners online. But as things stand at the moment, there is still excess inventory. And so the people with excess inventory are a mixture of people who bought, overbought and still have them and haven't yet managed to put them all online. Or people who bought them on a secondary market, and we'll talk about secondary market in a bit. Or in some cases, there was miner financing where lenders would provide the financing to miners to buy ASICs. And in some cases, some of those companies went bankrupt during 2022. And so the lenders ended up with miners in storage in some cases as well. Plus the manufacturers are not selling as fast, so they may have some excess inventory at the mining manufacturers at times as well. Now, of course, mining remains profitable, but there is a new shortage, which is a shortage of hosting capacity. So there's lots of unused power in the world, but it takes sort of engineering and construction work to convert power, in a warehouse or near to a power generation plant or a substation into racks that miners can be installed in. It needs transformers, it needs cooling, it needs electrical work, and it needs capital. And importantly, there's a lead time in constructing that. And so, as I said, the amount of hash rate this year increased about 40% year to date. So, that's reflective of more hosting capacity becoming available, and that continues. But as I say, effectively, there's a shortage of hosting capacity and oversupply of miners. And so that's kept the price of miners or ASICs low so far. And perhaps we can pull up a graph showing that while we talk about that effect. Right. So this is the graph I was referring to, and you can see it covers the 2021 bull market. The yellow line is the Bitcoin price, and the orange line is the middle efficiency miners, and the red line is newer, more efficient miners. And so one axis on the left is the price of miners, and miners are generally in the industry priced in dollars per terahash. And so you can see during the bull market of 2021, when there was a shortage of miners, and people were optimistic about a future price trajectory and wanted to capture that, elevated profit situation, that the price of ASICs peaked at around $120 a terahash, maybe a little higher in cases. And those same machines today are trading hands, in some cases, under $15 a terahash. So, there's a kind of 8 to 12 times drop in there. And that's compared to a Bitcoin price of, 65,000 at that time in 2021, when the miners reached $120, and 69 a bit later, where the miners fell back to 110. And so you can see that Bitcoin price has recovered quite significantly from late 2022, so from 15 to 16,000 at the end of 2023 to around 29, 30,000 today. And yet the price of miners is still depressed, right? And actually fell, this year. So, and that's just reflective of like an excess. It's a supply and demand situation. So, the hosting there's a shortage of hosting. So it's very easy to sell hosting. James has, many customers, but there's a shortage of capacity to sell. And so you've got, the market has swung from a shortage of miners in 2021 to a shortage of hosting, and that hosting is resolving itself as people bring hosting capacity to market. And so our fund thesis, and something that we experienced internally at Blockstream, at times buying miner inventory and selling it to enterprise hosting customers to provide a kind of full service package, is that if you look at this in hindsight, there's a bigger swing between the price of ASICs and the price of Bitcoin. So even if you were to buy miners using Bitcoin, there's a potential to make as much as double the investment pre-tax in Bitcoin terms. In this graph here, you can see that, if you were able to buy miners at sub $15 terahash, and once the shortage of hosting resolves and the inventory of miners is used up, the price of miners we expect to pick up again. And so that's the thesis. The fund will use investor money to buy new in-box miners and warehouse them. So we won't operate them. We'll keep them in a new condition and store them in secure warehouses, bonded warehouses, and sell them back to the market when the market conditions reverse, so that there is once again a strong demand for miners driven by profitability and availability of power, which does require the inventory to be significantly put to work. So use the excess inventory to be absorbed by the market.
So Adam, if I may ask one quick question here. So you mentioned right now at the moment it's $15 per terahash, kind of sub in that threshold the equipments are being priced. So what are the key factors according to you? And maybe James, you can also add your insights coming from the market. So what are the prime factors that influence the ASICs price in the market in the current scenario at this stage?
Well, it's really down to supply and demand. So, there's an excess in supply. The typical buyers already have inventory, so they're not looking to buy more. So until they have used up their inventory, there won't generally be a market buying more unless they can buy them at a cheap price. So it's a buyer's market, so they're going to negotiate at a low price. And some of the buyers of ASICs or people who ended up holding ASICs, like the lenders, are not even in the mining business, right? So they just have warehoused inventory that presumably they would like to recoup their loan cost if they absorb the loss on the loan. So yeah, it's a supply and demand situation. And so I'd say, that's probably below even the manufacturing cost for new equipment as well, right?
And I also see, in 2022, the energy prices went through the roof, and they're starting to normalize now. I'll go back to historical norms. But those energy prices, especially in the summer of 2022, drove the profitability to negative in a lot of cases. And some of the providers, the hosting providers out there, or people mining for that matter, weren't making money, and they couldn't service their debt if they were financing the miners, and it put them in a really bad position, which now which kind of drove people away from mining, or we because of the profitability. But now we're starting to see the recovery of the energy. And we're also starting to see new financing options. In the past, a lot of the finance options were using Bitcoin as collateral. So when Bitcoin dropped, obviously the collateral being held wasn't worth the value of the machines being sold. So we had a lot of those type of scenarios in 2022, and we're starting to see that recovery. In addition, like Adam said earlier, there's a lead time in order to get additional capacity online. And a lot of the larger miners out there are starting to scale vertically, and to put up their own facility, it takes quite a bit of time, right, to prepare a facility. In addition, even hosting providers like ourselves are building additional capacity. So we see quite a bit of capacity coming online, by Q1 and in Q1, which will provide a place for folks to plug in the miners that they have sitting in inventory, and increase start drying up some of the supply on the market today. So we see that shifting, towards the end of this year and the beginning of next year. Adam, you want to add to that?
Yeah, I think the other thing to bear in mind is that profitability is up quite a bit this year. And so you can see that year to date, the Bitcoin price is up 80%, and the hash rate up about 40%. So the Bitcoin mining revenue is up in a similar range, like 35% or so, right? And of course, profitability is up even more percentage-wise, because a large part of the cost of mining Bitcoin is the electrical and operations cost, right? So if your revenue goes up 35% and your margin was 10%, your profitability increased enormously. And so, it depends on each company's operations, their cost of financing, their electrical cost, the efficiency of their miners, and so on. But I think indications are that miners out there are able to mine Bitcoin for sort of $10,000, $15,000 per Bitcoin, maybe 20,000 at the less efficient miner and power cost range. But there's still a decent amount of profit in there. And, as we get closer to halving and through the halving, if the Bitcoin price improves across that period, then it will set up another condition where there's a new run to absorb all the inventory and then start to look for new miners. And part of the trick is that the same conditions that led to this oversupply will kick in again, which is once the inventory is used, there will immediately be a shortage, and that shortage will tend to persist for about 6 months or so before new manufactured equipment can become available, because the manufacturing process for the ASICs, the actual chips, takes about 5 or 6 months at the foundry level, plus the machines have to be assembled. plus there are supply chain constraints, right? So just because somebody can produce a batch of ASICs and finish them in machines within 6 months doesn't mean they can supply hundreds of millions of dollars of them in 6 months' time, because the supply chain has the capacity too, right? But they will start to produce machines. And so during that window, the BASIC note will be able to, we'll aim to sell back inventory into the market. So I think effectively the ASIC note is providing a useful function in providing liquidity to miners today, to people who have the inventory and would like to convert it into cash. So they can either sell, or they could sell and buy the ASIC note, so they have the liquidity, right? So if they are holding the BASIC note, if they're currently holding miners, they have to do a negotiated sale, right? Whereas if they end up selling their inventory to the BASIC note, and then they choose to use the proceeds to buy more notes, then they have a way to be more agile in the market, I would say. Yeah.
So in that case, like what you just mentioned here, if I may summarize quickly for the audience also. So the basic structure contemplates to buy the equipment. It's a very interesting opportunistic vehicle in that sense, buying the equipment at a preferable rate and selling it in the market as the market evolves, right? So what is the time duration you're considering in that regard? So what is the time duration we expect that the returns can be significant for the investors, and what is the range you're considering at the moment for the basic structure?
Yeah, so you can see, one factor is the halving. So we can see that the halving is estimated April next year, which is about 9 months from now. Historically, of course, you can't use the past Bitcoin price to predict the future, but historically the Bitcoin price has tended to increase, 6 months post-halving or something like that. So we'll see if in practice the Bitcoin price continues to grow this year, or if it's more next year that it happens. So the initial duration of the note is 24 months, but as the note, nobody has a crystal ball, and it may be that the price of miners gets very high in the longer term, but we won't be looking to hold miners too speculatively. So we're trying to capture a return on investment and manage the risk profile there as well.
Yeah, you mentioned, Adam, there is no crystal ball, but what we know is when the halving is happening is that the rewards, at least in Bitcoin terms, will actually halve. Does this mean that what is it from a perspective, from an innovation perspective of the ASICs? Because at that point of time, more powerful miners will be probably required in the market. Is the innovation cycle so fast to adapt to this halving event, or the other miners who are out now will be sufficient to do the mining at that point of time?
Yeah, historically, the halvings have been fairly smooth in terms of, continuity of business operations for miners. And that's typically been a range of factors. One is people slowly upgrading to newer miners, which are more electrically efficient and therefore, have a lower operating cost. The retiring of older generation miners, making space for newer, more efficient miners. And also, of course, historically, Bitcoin prices appreciated. So if you think about the halving, it reduces the number of Bitcoins mined, per day by approximately half. A bit, the decrease will be less than half, of course, because there are fees and so on as well. So anyway, if you think about that as going down by a factor of 2, so halving. And historically, the Bitcoin price has gone up by a lot more than that. So of course, it's volatile year to year, but over the last decade, Bitcoin has basically doubled every year. So on average, there's been an 8 times increase in miner revenue during a 4-year period, where the net mined coins has dropped by half after that period. So there is a profitability, and people plan for it too, because they they can see approximately when it will happen. So yeah, I mean, it might lead to some consolidation. Typically, if the less efficient miners leave, they're not typically bought back. So the old miners won't typically be bought on a secondary market because people will be more interested to buy new miners. So that that makes space for newer, more efficient miners as well.
And what Blockstream's position in the marketplace, we have the opportunity to speak to a lot of folks, customers of our own, and just other peers in the industry, and we've realized that the strategy going forward for a lot of these firms is to look at their existing fleet, even before additional capacity, just their existing fleet, to figure out what they're going to do with that, and try to get the most useful life out of the existing lower efficient machines before going into the halving. And then a lot of the strategies are to replace prior going into the halving, which will increase the demand for the lower efficient machines, which is our strategy, is to focus on those first, right? Because of the depressed price that they're selling at current. So we do see a lot of the more efficient machines being in higher demand towards the end of this year and the beginning of next year, going into the halving, and even through the halving, as people realize that their profitability has been decreased, and there's an opportunity for them to gain more profitability by upgrading their systems.
So I think the connected question, which I may have on this point, is what kind of equipments you're planning to acquire in the basic structures, and are you planning to buy directly from the manufacturers in that regard, or also planning to buy it from secondary markets for the trading purposes?
Well, very, very good question, right? Currently, because of the oversupply in the marketplace, the secondary market is yielding cheaper prices, and they're easier to negotiate with because of the oversupply. So we see, our initial strategy is to look at the secondary market for the purchases, right? Which will be the cheapest, and there's inventory them, not put them to use. We're just going to warehouse them in a bonded warehouse, but that may shift, right? As supply diminishes on the secondary market, you may see the manufacturers' prices staying flatter and becoming more cheaper, becoming cheaper than the secondary market at that point. So again, an advantage that Blockstream has is through our relationships and position in the market. We have that heartbeat continuously, right? I speak to people daily and weekly on these scenarios.
Right. So, I mean, effectively, we're going to look at the potential return on investment on a miner in Bitcoin terms. The fund is a Bitcoin basis fund, which we'll come to later. And so, it's the market conditions in which you can, sell for attractive prices. An efficient miner is wider than the market conditions where you could sell a less efficient miner. So, we're considering efficient to be sort of 28 joules and below, and above, let's say 28 joules, and middle efficiency, and things above like 38, 40, that's older generation, so we wouldn't buy those. Now, so it depends on the target is return on investment. So if somebody is almost giving away new in box middle efficiency miners, perhaps we might buy them on the expectation that we'd have to sell them at a 50% discount, into next year. But if they're selling at a 75% discount, that might return a higher return on investment. But I don't think we would, overweight that, because in, a slower market with less, of a profitability, or less of a shortage of miners, let's say, which is an indication of miner profitability rebounding, you'll be able to sell the more efficient miners more easily. Now, there's certainly been cases in the past where people will buy anything that mines. They'll buy previous generation equipment, and even the manufacturers started manufacturing previous generation equipment historically because they ran out of accessible foundry capacity that they could buy on the latest gen. But that range of conditions is a bit narrower, so we wouldn't focus on that. So I think we would tend to weight towards more efficient machines at reasonable prices, Now, of course, if that changes, like the more efficient machines get in high demand and we're still in market buying, maybe we'll start to buy some middle efficiency machines just to keep the margin available.
So in that case, like I understand if James, you mentioned it on that point. So you will hold those equipments in a bonded warehouse kind of thing. So which kind of markets you're thinking, and maybe also for the audience, because BMN, just to give a quick reference, in the Blockstream Mining Note, effectively the equipments were used to mine. So are you planning to use the equipment in any ways to mine, or this will just sit idle in the warehouse and you will find the right time to just sell it as price appreciates and there is a premium to collect on that?
We're planning on just putting them in a warehouse and holding them just to sell, right? So we're selling them brand new, fully intact, not used at all. If someone's looking for a yield, then we would point them to our BMN product.
Yeah.
I think it's quite important to have new miners, because when miners are relatively cheap, it's a risk that people don't want to take to buy a used miner, because then you need to know how it was handled. Was it cooled properly? Was it filtered properly? Is it worn? How long was it used? Is it worn out? Is it about to fail? And that's quite hard to evaluate. And so, when you can buy new miners for sub $15 a terahash, I think used miners is not a very interesting market. And so it's also much easier. So, come time to resell these, all these miners we're buying on, even though it's a secondary market, they are new in box. They've never been open. They've never been used. They're still factory sealed straight from the manufacturer, shrink wrapped pallet with, dozens of machines on one pallet, right? So that is what people prefer to buy, because they have the assurance that there's no pre-existing wear on them.
And as you mentioned, like you will warehouse like these miners for a certain period of time. How does it look like, this kind of warehouse? How does security look like in this sense, or how do you mitigate like these kind of risks, having like the miners sitting in the warehouse?
Yeah, so it's a kind of specialized area, but there are companies that specialize in providing secure warehousing for high value items. So it's called a bonded warehouse, and so we will use kind of independent, highly secure bonded warehouse locations, and with insurance for applicable failures as well, like fire or theft, that kind of thing.
Yeah, I think like this is kind of very interesting, because my understanding is you are planning to buy it, hold it for a certain period, and sell it. But are you also constantly trading the equipments on a constant high velocity element?
No, so it's a kind of one-shot opportunity strategy. So we buy the miners, we hold them until there's, until in our judgment it's the right time to sell them.
Okay, so I think that, Adam, coming to the question on the redemption. So how this vehicle will actually buy and sell, and will in my understanding, just correct me if I'm wrong, is the vehicle buying the equipment and selling once, or it's constantly buying and selling during the entire life cycle and then redeeming constantly or redeeming one time? That may be a connected question in that regard.
Yeah, so it's a one-shot strategy. So we go through a period of acquiring miners using the investors' capital, and then when we judge the market conditions are at the right point to begin selling, then we start selling. And we actually, because the product is a Bitcoin basis fund, we hold the proceeds of the sale in Bitcoin. So if they're sold for Bitcoin, keep the Bitcoin in the fund. If they're sold for dollars, we use the dollars to buy Bitcoin and hold it within the fund. And then once all the equipment is sold, there's an end termination redemption of the fund, but there's no kind of, buy equipment, sell it, then buy it back. So there's no kind of speculative buying and selling.
So in that case, like just for I think the understanding over here, so you're issuing different series, because how we did for the Blockstream Mining Note, even in the basic structure, different series will be issued, and each series will be kind of redeemed based on this time frame, the maturity, and in that regard. So this will be redeemed once, and that will be the discretion of of the Blockstream in that regard, or the vehicle, and that depends on how you can liquidate the holdings, ASICs holding, right?
Right.
Coming to the, I think regarding the fees side, and this instrument is a very interesting instrument because it's issued as a note, but it has certain elements of how you will see it economically a vehicle that works like a fund, but it's not a typical fund in this case. So what are the fees if an investor has to calculate? And because this is the question everybody considers. So what are the fees of this structure that you're contemplating at the moment?
Right, good question. So it's structured as the similar way to a hedge fund carry model. So there is a 2% management fee. There are applicable fees like, legal filing fees, accounting filing fees, and warehouse, bonded warehouse storage and insurance fees. The carry calculation, the retained profit on the part of the investor, is calculated using Bitcoin as the currency. And so the point there is, let's imagine a scenario where 90% of the machines are sold next summer, and the proceeds are in Bitcoin, and Bitcoin price goes really high after that. And so now the investor who let's say the investor invested using Bitcoin itself, right, which is a sort of central thesis here, that this is a Bitcoin on Bitcoin investment. They would not be happy if the fund took 20% of the Bitcoin price appreciation after sale as a profit. So what we're counting is, if somebody puts in 1 Bitcoin and they get out 1 Bitcoin, there's no carry. If they put in 1 Bitcoin and they get out 2 Bitcoin, then there's 20% carry on the difference, i.e. 0.2 Bitcoins, minus applicable fees, etc.
So in that case, because this is very interesting, I think we discussed elaborately on this topic in the past, because in BMN, we saw a lot of investors came with Bitcoin, which I think we were quite surprised also internally in STOKR, and few people came in the USD denominated like a stable coin like Tether. And for this specific product, I understand, I think the rationale that you are taking here is, if the Bitcoin price appreciates, definitely it's not because of the activity of the basic structure, but it's collectively because of the market, and investors should not be penalized. It will not be the same structure as GBTC model, where independent of the BTC price, we are charging a flat. So even if we are not performing anything, we still get some piece of the cake. So is that the logic that you're considering here?
Well, I mean, the GBTC fund is charging only management fees, but because this is a discretionary opportunity fund, it's charging a hedge fund carry formula. So 20% of the upside. It's just that we're anticipating that most of the investors would invest using Bitcoin. And so the benchmark they're comparing the funds to is, if they have 10 Bitcoin that they're considering to invest in the fund, their alternative is to hold the 10 Bitcoin in cold storage. And, if the price is 100,000 or 200,000 in a couple of years, they would say, well, I would have got that anyway if I kept it in cold storage. So I don't want to pay you guys carry for the price appreciation. And so we take that out of the formula. So the carry is a sort of success fee above the Bitcoin price appreciation in effect.
So you're considering like a scenarios where happens, like if I'm a Bitcoin basis investor, what happens if I just buy and hold Bitcoin in that? And what is the performance of the basic in that meantime? Is there any projection that you have done internally on that regard?
Yeah, I mean, looking at backtesting, we can see that, there is a potential for, if things repeat from the last cycle, that, a return on investment of 2 or 2.5 times is possible, but you've got to look at the middle case and the worst case and so on. So, absent a crystal ball of the perfect time to sell, we will, begin capturing profit at varying levels, right? So, and of course there are downside risks too, if things don't work out the way people are thinking about the halving, or about the absorption of machine risk, or the availability of hosting and so forth.
I think if I consider a comparative product, can you think of any similar comparative product that can have the similar structure as basic, or this is kind of a very novel instrument at the moment?
Well,
I cannot think of anything at the moment. So yeah.
Yeah, I mean, as I understand it, most of the so-called crypto hedge funds, this is not a hedge fund, right? But they are effectively charging people a carry for Bitcoin or altcoin price appreciation. And, of course, that's very unattractive to people who are, just cold storing Bitcoin, because that would seem to them that, they would be safer to cold store the Bitcoin, or the carry is going to be a tax on the success, right? So they could, for example, if it was a dollar basis fund, there could be scenarios where the fund made money in dollar terms, but lost money marginally in Bitcoin terms, and yet you got charged 20% of the dollar price appreciation, so you got back less Bitcoin than you put in. So we wanted to avoid that scenario and make sure that the carry only applies in the event that there's a profit compared to the Bitcoin invested in terms of the Bitcoins paid out, after internal fees and taxes and so on.
Yeah, I think we touched upon almost all the points that we wanted to discuss definitely on regarding the instrument and its basis. Maybe I think we can go to the discussion on the tokenization element of BASIC, which is also interesting for us because being a tokenization agent in this entire process, we actually learned a lot. And as always, in every project, we learn a lot. We learned about the industry, but we also go through the entire process. And this, as you mentioned, it's a very new instrument. For us, it was quite interesting, and me and Tobias were discussing quite a lot, and we took quite some time, and thanks to also the Blockstream's internal legal team. So what the Blockstream Mining Note is, we know it, what we were discussing about the BASIC note, what the BASIC note is and how it has been structured and what investors are actually purchasing legally in that sense.
Yes, it's true, Arnab. When we started the discussion with the Blockstream team, there were different considerations we had to take into account to choose the right vehicle for the basic node, right? And foremost, obviously, we had to think about how to mirror the performance of the ASICs in different lots, right? Second was obviously highest investor protection, especially after all the learnings the markets did over the last years. We wanted really to cater for a vehicle which provides a really solid investor protection, right? And then obviously the ability to tokenize the nodes in the end, so to have the ability to use liquid to tokenize actually the basic node, right? So we start with the investor protection to give a little bit of high-level overview of the structure which is built. So for us, the natural choice then after considering these specific items, we were thinking of Luxembourg securitization structure, and the reason is Luxembourg securitization structures cater exactly for these three considerations. So one is the investor protection. So basically, what's happening, the basic note is in the end a limited recourse obligation. It's a very difficult term, but in the end, what it means is that the investors have an exclusive right to the proceeds here in this case, which derive from the sale of the ASIC miners, right? So this is a very unique structure which provides a high level of investor protection, because actually the nodes are really directly linked to the underlying proceeds, whatever will be happening here in the selling and selling of the ASICs miners down the line, right? And another point which is very important, I think, from an investor protection perspective, is that the vehicle itself is ring fenced. So in case any of the players who are involved in the setup of the structure goes bankrupt, it will not get affected at all. This is obviously an essential difference to what happened at FTX and Celsius and the like. So investors are highly protected in this regard, right? The second point, I think, which is very important, is like obviously the flexibility. So to cater really for the possibility to mirror the performance of the ASICs lot, and then ultimately repatriating the proceeds deriving from the acquisition, holding, and sale of the miners to the investors. So the Luxembourg securitization vehicle is very well equipped to do that, and obviously then also provides for the possibility to tokenize. Luxembourg is a tested marketplace for tokenize this kind of financial instruments, and the Luxembourg securitization structure provides for exactly like this kind of flexibility. And last, as we have discussed in the last almost an hour of the possibility to have actually different series. So different series means the investors invest for a certain amount in a specific series, which is like linked and to a lot of ASICs miners, so they exactly know what they are buying in, right? And they don't face like cross contamination in this sense. Yeah, and this is basically in essence the Luxembourg securitization structure provides for all of this, and in this sense it's like the ideal vehicle for issuing like the basic note.
I think it's a very interesting element that you Tobias highlighted is after the FTX. I think a lot of people are talking about the element of segregating the asset from the balance sheet and the bankruptcy risk and everything. And it was actually for us internally, for the audience, it was a very key consideration also when we are structuring any instrument to look at it from an institutional viewpoint. Is this instrument be able to be purchased by institutional investors? Because for this basic note, the minimum investment ticket is 115,000 USD, and that's equivalent to 100K in euro. And this is a professional investor product. I think one key things I would like to also highlight is this basic note is issued on Liquid Network as a transfer restricted asset. That means if you're holding in your Liquid wallet, you can actually hold those assets via your own private key ownership, those assets in your own wallet. The only thing you have to do, you have to whitelist that wallet, and for that you have to go to STOKR page, create an account, do the KYC AML, because these are kind of registered securities, and these are registered securities in that sense. So these are regulated under the EU capital market laws in that way. So you cannot hold it anonymously. So that's the reason KYC has to be enforced. And STOKR, as a virtual asset service provider supervised by the CSSF in that regard, it's kind of the obligation that we have for passing and doing all the KYC AML checks in that regard. I think we touched upon almost all the major points that we wanted to go through it. Adam, and James, if you want to share something.
I had another question, which maybe for STOKR, the transferability or liquidity, the ability for unit holders to sell in the market to other whitelisted investors, and the quantity for the secondary sale.
So basically, as these notes are issued in series, the transferability is embedded in each series, and in this sense, each of these series notes are actually also fungible and can be then peer-to-peer transferred via our embedded whitelisting process at STOKR.
So they could be transferred OTC using SideSwap, for example, the SideSwap market.
In principle, I would say yes, because the swap feature in SideSwap is quite interesting. And also one note on STOKR right now, if you're creating an account, you are automatically getting exposed to the SideSwap interface, and you can use the inbuilt swap feature that is already in the SideSwap from the day one. Once the tokens are made transferable, for sure. Yeah.
So the investor's choice would be to hold to maturity and receive the final redemption, or potentially to sell in an OTC market with a negotiated price at some point in between those dates.
I think it's the beauty of a tokenized security in that regard, right? You can wait for the maturity, and if you want an immediate liquidity, you can definitely use a SideSwap kind of features, or maybe at some point there's a centralized exchange that list is, you can also go there. But I think as the market matures of tokenization, we will also see you can collateralize it, borrow money, the one-on-one of the finance that will be triggered. And I think that's the beauty of tokenization, and we are quite happy how the liquid functionalities work in that regard, that provides different lot of value add and the features, and also the modularity that is required for any tokenized securities.
Yeah, and coming back to a point Tobias made, with the Blockstream Mining Note, there were 8 tranches sold, and they are all interchangeable or fungible because they're all within the same series. But here, the individual lots are separate series, so they're fungible only within the series. So if you buy series 1, it will have a different cost basis, potentially a different resale price, and I suppose potentially a different redemption date to a series 2, for example.
Yeah, absolutely. That's correct. Yeah. Mm-hmm.
This product is, as with the Blockstream Mining Note, informed by our, Blockstream's market experience of operating in the market and seeing an opportunity. And this is one of the very few Bitcoin on Bitcoin investment products on the market, in the sense that it's anticipated, as with the BMN, that most of the investors will actually invest using Bitcoin, and subject to the risk factors, the basis of the fund is Bitcoin itself, and the hope is that the investor should get a Bitcoin on Bitcoin return with a carry that doesn't charge them for the Bitcoin price increase, but only charge for the increase in the number of Bitcoins that they come out with.
Perfect. Thanks a lot for the quick summary, and and we are quite excited actually to have it also on our platform. If you're interested to learn more, for the audience, please head on to the STOKR page. The link will be in the description below. You can learn more about the offering. There is also a Telegram group. That's link will be also here. It's a Blockstream Finance channel. You can also ask questions there. And if you're interested to get the legal documentation, to go with the investment flow and all these things, click I'm interested button in the STOKR page, and the Blockstream team will reach out to you. Thanks everyone for listening to us, and also please feel free to share your comments in the comment section. And we are also hoping to record another video specifically regarding the basic product. And thanks Adam, thanks James, and thanks Tobias for joining us. See you soon in the next recording maybe.